So take a look at what's happening with shares of Didi. We're watching them fall. They're off more than 20%, now down about 21%. As you can see, they're falling after the Chinese regulatory authorities cracked down on Didi. And we learned, according to the Wall Street Journal, that the Chinese regulators actually approached the ride-sharing giant, asking them to delay their initial public offering last week because they wanted to conduct a thorough self-examination of their network security. That, again, from the Wall Street Journal. Let's invite into the stream a guest to help us understand what all of this means. Darrell West is the Brookings Institution Vice President and Director of Governance Studies. Good to have you here, Darrell. And before we even jump into what this could mean for potential IPOs and Chinese investment, I would imagine the shareholders, I'm not sure where you would sue. Are they governed by the laws here in New York City or New York State? Would they be governed by Chinese regulatory law? What recourse might investors have if Didi was asked to delay this IPO and then came to market knowing they could be in trouble?
I don't think investors are going to have any recourse. The Chinese government clearly does not want any independent power centers within its society. When Didi did its U.S. IPO, it raised $4.4 billion. So that gave that company a lot of autonomy from Chinese investors. The government did not like that. It's removed the Didi app from Chinese app stores, which means Didi can continue to serve its current customers, but it cannot take on any new customers. And so that is a very powerful signal from the Chinese government that you better play ball with the government. And if Didi doesn't pay attention this time, there are other things that the government can do to it that would create even greater problems for U.S. investors.
Darrell, we're seeing this not only in shares of Didi today, off more than 21%, but a number of Chinese companies listed here in the U.S. are also under pressure as a result. I guess as we think about investing in some of these Chinese companies going forward, is this type of fear around regulation and the interference that we're seeing from the Chinese government, is that a fear that you think is always going to be there with some of these names?
It is something investors should take seriously because we're actually seeing a techlash in a lot of different parts of the world. We're seeing it in China, obviously, but also the United States, in Europe. I mean, regulators around the world are adopting a tougher stance on technology in general. So there's likely to be more regulation coming from a variety of different sources. But particularly in China, the U.S.-China relationship is so complicated these days that China is cracking down on its own Chinese companies. Alibaba was subjected to a $2.8 billion fine for alleged antitrust violations. Didi now is being subjected to a cybersecurity review. China enacted a new data security law last month in which companies have to get government approval to transfer any Chinese data outside of China. So in a variety of different ways, China has beefed up its regulatory toolbox. And it showed clearly in the case of Didi, it's not afraid to use some of those regulations.
Well, Darrell, you brought up Alibaba, and we saw what they did with Jack Ma just about 2 months ago. What does this say to foreign investors looking at Chinese stock? Should we be avoiding China?
Well, it certainly is sending a lot of warning signals to outside investors. China is getting tough on its own tech companies. In fact, some of the brands that have been the most successful internationally are now being subject to very tight restrictions, large fines, or much stronger regulatory actions than what we have seen before. I mean, the old message the Chinese government was sending to these companies was go national and go multinational, like they wanted them to go into foreign markets and become successful that way. That seems to no longer be the case. They're worried that these companies are developing economic clout that could translate into political clout and therefore could become a problem for the Chinese government. In a number of countries, we've seen billionaires become politically active. China obviously does not want any of the wealth being created by these tech companies to start to be used internally to upset the political status quo. So there are lots of reasons why I believe investors should be very wary of China right now.
Also, Darrell, when it comes to the Chinese government cracking down on data and really wanting to control the data from these companies, I guess, what does this mean for the U.S. versus China, this race to AI and this race here for the next chapter? Does this give China an edge?
Well, the two big players in AI now are the United States and China. I mean, that's where all the investment's taking place and where most of the innovation is taking place. So clearly, there are a lot of U.S. concerns about the AI investments taking place in China. We're seeing it in the defense area, in the finance and healthcare, and a number of other segments. And so we're seeing the Biden administration starting to counter the Chinese threat by investing in U.S.-based AI, putting more money into R&D, putting more money into higher education so that the United States can maintain the innovation edge that we've had for a long time. But certainly going forward, it is a very competitive marketplace in terms of AI, and there's a lot to worry about in that area.